Hey there, fellow finance enthusiasts. Today, I want to discuss, will the US and Canada enter a recession in the third quarter together? Nouriel Roubini. Are you ready for a thought-provoking, enlightening, and perhaps even paradigm-shifting discussion that could reshape your perspective on the economy? We will delve deep into the economic landscape, peering beneath the surface to unravel the mysteries that lie ahead. Our goal is to gain a comprehensive understanding of whether these two economic powerhouses will display resilience in the face of challenges or succumb to the harrowing forces of a crash. We are about to plunge into the depths of economic discourse, exploring the fascinating interplay of factors that could determine the fate of these nations. No stone will be left unturned as we navigate through the complexities and unveil the captivating dynamics at play. Head first into the captivating world of finance and discover the untold stories, the surprising connections, and the exciting possibilities that await us. Your presence and active participation in this conversation make all the difference. So, let's set forth on this voyage of discovery and unravel the mysteries that lie within. Let's begin our exploration with the intriguing question: will the economy undergo a smooth transition or face a sudden and severe downturn? Get ready for an informative journey as we navigate through various economic indicators and gain insights from experts. Now imagine this: the economy is like a wild horse racing towards an uncertain future. As the Fed tries to rein it in with rate hikes, the stakes get higher. Will they succeed in taming this galloping beast, or will it bolt towards a hard landing? Hold your breath, for the indicators paint a worrisome picture. Credit growth tightens like a corset, regional banks struggle, and forward-looking indicators point towards contraction. Even the global landscape echoes with signs of recession. It's been a turbulent ride, my fellow enthusiasts, and the labor market and consumption growth show signs of weariness.
Well, if we define it by crash, economic downturn, a hard landing, I would say that the probability of a hard landing, meaning at least 2 consecutive quarters of negative economic growth, are higher than the one of a pure soft landing. The economy is slowing down. The Fed is raised rates, and in my view, they'll have to raise them more because inflation is still too high, both wage inflation and core. They'll take a pause, of course, in June, but might need to raise rates more in July and September.
Behold the cosmic alignment that portends a looming recession, casting a somber shadow over the prospects of a gentle landing. The path that lies before us is riddled with obstacles, and the economy must summon all its strength to navigate these treacherous waters. It's no walk in the park, my fellow enthusiasts. But fear not, for in the face of adversity, there exists the potential for triumph against all odds. Will the economy defy expectations and discover a sanctuary amidst the tempestuous storm, or will it succumb to the powerful forces of the downturn? The solution to this puzzle remains veiled with the passage of time. Therefore, let us maintain a watchful eye, stay knowledgeable, and prepare ourselves for the exhilarating surprises that lie ahead on this captivating expedition. Together, we shall hold our breath, united in our quest for understanding, as we witness the enthralling drama unfold before our eyes, brimming with insights and captivating forecasts. The forecast whispers of a potential recession in the third quarter of 2023. But let us ask ourselves, is this merely the tip of the iceberg or a harbinger of a prolonged storm on the horizon? Amidst the foreboding credit crunch, poised to constrict credit growth, we find ourselves contemplating the gravity of its impact. Could its tendrils extend deep into the depths of 2024, causing ripples of uncertainty to reverberate throughout the economy? As the Federal Reserve takes a temporary hiatus, basking risky assets and bond yields in a favorable light, a lingering question emerges from the depths of our minds. Will the resumption of rate hikes, akin to a resounding encore in the months of July or September, steer us towards a treacherous financial crossroad? The suspense lingers in the air. The global stage, adorned with geopolitical turmoil, sets the backdrop for a truly captivating act. Picture the chilling tango between Russia and Ukraine, entwined with an icy rift between the United States and China, murmuring a tale of rising commodity prices. And behold, as this grand drama unfolds, the Middle East steps forward, unveiling its own ensemble of risks, with the haunting specter of Israel's strike on Iran taking center stage. As tensions simmer and simmer, we are left to ponder the far-reaching consequences. Let us immerse ourselves in this tale of intrigue and uncertainty. Together, let us unravel the mysteries that lie ahead and seek wisdom in the face of the unknown. The stakes are high, the challenge is immense, but the journey is one of discovery and growth. As tensions simmer, we're left to ponder the far-reaching consequences. Will this volatile performance reverberate across the global economy stage? Now, I implore you to share your thoughts on this matter. What do you perceive in the swirling currents of the economic landscape?
We don't know yet. I think it's going to depend on several factors. One, how much of this credit crunch is going to reduce credit growth already this year as opposed to pushed into 2024. The Fed is going to pause for the time being. That's good for risky assets and bond yields, but they may have to resume hikes as early as July or September, in my view, at least a couple of more ones, and that's going to lead to further concerns about the economy.
Well, you see, he humorously portrayed the credit crunch as a slow-motion stumble towards 2024. With the Federal Reserve hitting the pause button, their potential resumption of rate hikes became a suspenseful encore. The global geopolitical situation, portrayed as a chilling Cold War with dramatic conflicts, adds another layer of uncertainty. As we navigate these challenges, we are left pondering which events, comedic or calamitous, may ultimately tip the scales towards a potential recession. In reference to Jeremy Siegel's recent remarks, he has presented three key expectations. Firstly, he anticipates a pause in the Federal Reserve's actions, suggesting they won't hike rates throughout this year. This differs from the viewpoint expressed earlier. Secondly, Siegel maintains his expectation of a recession, but predicts it to be of a milder nature. As for whether the speaker shares the same prediction, their remarks did not specify the severity of the potential recession, leaving room for differing perspectives. Lastly, Jeremy Siegel also highlighted the importance of monitoring global trade tensions and their potential impact on the economy. This additional factor underscores the complexity of the economic landscape and the need for careful observation and analysis.
Well, I do believe that the Fed will pause, but then will have to raise rates more because they're going to change their forecast about core PC inflation. By year end is going to be closer to 4% than 3%. And therefore, staying at 5.25 is not sufficient. The impact of the credit crunch on credit condition is still ongoing and is going to become, in my view, worse. There are problems, as we know, in some parts of housing and commercial real estate. So certainly there is going to be a recession. Whether that recession is going to be short and shallow as opposed to more severe depends on many factors. How much persistence of wage and price inflation, how much global factors that are going to be negative, what's going to happen to commodity prices, to geopolitical factors, and further tightening of financial conditions.
Certainly, the speaker's analysis sheds light on the multifaceted factors influencing the current wave of inflation. Amidst this discussion, a whimsical term emerges: excuseflation, or more formally, profit-led inflation. It raises the question of how much influence corporations have in prolonging the existing inflationary environment. Are they inadvertently hampering our progress towards taming inflation? Or is there more at play? This concept adds an intriguing layer to our understanding of the lingering inflationary pressures and the role of corporate dynamics within this economic landscape.
Well, there is some evidence that because there has been a greater amount of concentration and oligopolies in many parts of the corporate sector, that corporates have, first of all, pricing power. Secondly, there has been a rising cost, wage cost and intermediate inputs and commodities, but some corporations have taken that one as an excuse for increasing prices even in excess of their cost.
There is compelling evidence suggesting that, due to increased concentration and oligopolies within various corporate sectors, companies have gained significant pricing power. Furthermore, rising costs related to wages, intermediate inputs, and commodities have provided some corporations with an excuse to increase prices beyond their actual costs. Paradoxically, this widening profit margin signals the persistence of inflationary pressures. When prices rise more than costs, workers feel compelled to demand higher wage increases to offset the impact on their real wages. While numerous factors contribute to the rise in inflation, including oligopolies and corporate pricing power, it's important to understand their significance in a larger context. Now, how do you think the interplay between rising prices, squeezed real wages, and worker demands for higher compensation affects the overall inflationary landscape? What do you think about this topic? Share your thoughts in the comments section below. Don't forget to like, share, and subscribe to this channel. I'll see you in the next video.